Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Today we're talking about a policy idea that keeps resurfacing around the world, taxing unrealized gains. Now, if you've ever underwritten a deal, you know the difference between gain on paper and cash in the bank. Unrealized gains are accounting gains. They exist because an asset is worth more today than it was yesterday, at least according to some valuation method. But until you sell the asset, refinance it, or otherwise monetize it, that gain is not cash flow, it's potential. It's on paper. In the Netherlands, there's proposed legislation that would tax unrealized capital gains. It's now being discussed under the umbrella of reforming Box 3, part of the Dutch personal income tax system that applies to savings and investments. The Dutch lower house adopted the bill on February 12th, often referred to as the Box 3 Annual Return Act, with an intended effective date of January 1st, 2028, although the finance minister has already indicated amendments are probably going to be needed if the Senate's going to approve it. So why is the Netherlands going down this road? Well, it's because their current system has been under pressure for years. Historically, Box 3 taxed investors based on a deemed return, a fictitious assumed rate of return, rather than what someone actually earned. When interest rates were near zero, people with cash savings were taxed as if they were earning healthy investment returns. Now, the courts rejected that approach, and the government has been trying to craft a replacement ever since. The Dutch tax administration even has public guidance on how the interim method works for recent tax years, still relying on fictitious rates tied to asset mix. Now, in response, a bill was advanced to move from these deemed returns to actual return. The catch is in how you define actual return. Under the bill adopted in the lower house earlier this month, the system would tax actual annual returns at a flat rate, and that includes value increases that have not been realized through a sale. In other words, unrealized gains. Now, it's clear that that applies to paper assets like stocks and bonds, but now we've got to translate it as well into real estate. The proposed system is being built around taxing actual return. For most assets in Box 3, that means a capital growth approach. You pay tax not just on what you receive, like interest and dividends, but the actual change in value, including unrealized gains and losses. The proposal explicitly carves out an exception for real estate and for certain shares in startups. For those assets, the proposal uses the capital gains model, which means value changes are taxed at realization, typically when you sell, rather than every year as the market value moves. Regular income like rent is still taxed in the year it's received. We're seeing this pushback in the Netherlands right now. Even though the bill passed the lower house, the finance minister has acknowledged amendments are probably going to be required to get through the Senate. Let's step back and look at the principle. A well-designed tax system tries to avoid taxing phantom income. Phantom income is income that exists on paper but not in real cash. Real estate investors know phantom income from depreciation recapture, cancellation of debt income, and sometimes from partnership allocations. But taxing unrealized appreciation is a whole new level because it's divorced from any transaction. If you're going to tax unrealized gains, fairness demands symmetry. That means if the value goes down, the taxpayer should get immediate relief. Some reporting indicates the proposed system contemplates loss offsets and carry forwards, but the devil's always going to be in the details. How the losses qualify, how they're measured, and how quickly they can be used. Now, I want to connect this to a broader investing lesson. When governments are under fiscal pressure, they start to look at pools of wealth that appear stable and available. Real estate's visible, it's not local, cannot move across a border, and that makes it politically tempting, but since most people live in a home that they own, it's also political suicide if they start taxing people on that. As investors, our job is not to debate ideology, our job is to price risk. If you invest in a jurisdiction contemplating taxes on realized capital gains, you need to model a few scenarios. First, you've got to look at your liquidity. How much cash reserve does a project need to withstand an unexpected tax bill? Second, sensitivity to valuation. How volatile is the asset's mark to market? Prime example would be the price of gold, which has experienced extreme volatility. You could end up with a large tax bill because the price of gold went up. You end up paying the tax, and then a day later, the price of gold drops again. Third is the hold period. The longer you hold, the more you're exposed to annual taxes on appreciation, which can reduce compounding and shift optimal strategy towards faster turnover, even if that's not optimal from an investment standpoint. Then you want to look at investor alignment. If you're syndicating, it's not just your problem, it's a problem for all of your limited partners. If the tax is assessed at the individual level, then that might face different outcomes. So what should you do with this information? There are other jurisdictions that are toying with similar concepts. California is one that comes to mind in the form of a wealth tax. As you think about that, have an awesome rest of your day. Go make some great things happen, and we'll talk to you again tomorrow.